Wanted to jump in here live. I've actually wanted to jump in earlier, but we kept having power outages here, so it made it a little difficult. I am here live now. I hope you had an incredible week. I hope you had an incredible holiday um, and New Year's and everything, and that you're kind of getting things dialed in and set for 2023. It's going to be a big year. Um, and uh, and if I have anything to do with it, I hope to be with you the whole year, helping you out, helping you um, navigate the year financially, but navigate it to create a life, to create a life. The statement that I always say is to create a life that outlives you. Coming from a place of doing something that matters, doing something that's bigger than you. And so, do me a favor as you're coming in, let me know where you're coming in from. Say hello. Is that D Lash Company? Saw me speak in Huntington Beach in December. Thanks so much for being here. I hope you are great. That was a cool event, wasn't it? More to come. Doing a lot more speaking and everything. Getting back on the road. People are getting back together again, which is really cool to see. So and really kind of dialing in. There's a couple things I want to do. Look at that. There was a number of people. Sydney is in the house. Maine. I love this. All right. So we've got this, a lot of things going on. And one of the things I actually have something that I want to talk about. I'll answer your questions. If you have questions on money, business, life, whatever, I'm here. And we'll make it happen. Marilyn is on Facebook with me. Yeah, thank you. She said I was great at CHPC. I appreciate you. So here's the thing. A couple things I want to touch on, and then I want to open it up for questions. See what we can help. Someone asked me the question. What's the difference? What's the difference between those that actually make it, those that actually accomplish it, and those that don't? And the context, let me give you context. The question was revolving around uh, New Year's resolutions and saying, why is it that within 3 to 4 weeks, most New Year's resolutions fall by the wayside? And I said, I looked at them and I said, here's what I believe. The problem is we want too much. And he looked at me and he goes, what are you talking about? We want too much. When we put things in place as a want, okay, when we say it is a want, I want this, I want to lose weight, I want to make more money, I want to have a better relationship, I want. How many of you have done that? I know that I've done it. That's the way I used to set my goals. That's the way I set my resolutions. The problem with a want is it's soft. Okay, it's soft in the sense of you can let yourself off the hook. I wanted it. I didn't get it, but I wanted it. It's okay. Here's why I think this is important. If we are going to change our financial future, if you are going to actually be the inflection point of your generations to change the trajectory of your financial destiny, if you're going to be the inflection point of the generations to change the purpose, the impact, the things that you're doing, it can't be a want. It has to be a will. When we decide to create a resolution from a place of declaration that says, I will. Now that's scary because it's confronting. It's scary because it's a declaration. It's scary because when you say I will, it's an absolute. And with it comes the requirement of doing whatever it takes. And so when we start to think around our goals for 2023, when we start to think about resolutions, when we start to think about finances and money and relationships and health and all of the aspects of our life, if we truly intend to live a life that outlives us, we have to live it on the foundations of a declaration which starts with I will and not I want. I'm not saying not to have wants. I am saying to take those wants that are so important to you, those wants that are the priority, those wants that you know viscerally inside you want to have it, and convert them to an I will and make the declaration. Here, let me bring this home for you, because many of you know in June of 2019, I got diagnosed with cancer. They found a 5 centimeter tumor. They thought it was 5 centimeters. It turned out to be 7.5 centimeters. I went through 2 surgeries. They took out 3 tumors in those 2 surgeries. I went through 47 treatments up to now. By then, I didn't do 47 treatments, but I did a lot. That was June. December, they say you're clear. Everything's good. So I relaxed. I was okay. I was doing fine. And I do my first an event in April of 2020. The day after that event, I go in for another scope. And I'm laying on the table, and the doctor's doing the scope. And then I hear the doctor, the surgeon, say, "Oh, that's something. Not the thing you want your surgeon to say." And he found another tumor. And so I started to spiral again. I started to think, oh gosh, it's back. What does this mean for my life? Why did I get it back? Why did it come back? All those things that started to panic me, that started to freak me out, that started to stress me out. And then I had a conversation with a dear, dear friend. And he says, what would happen if you actually knew the outcome on the other end of this? And I said, what do you mean? He says, well, what do you believe your outcome is? I said, I will do. I'll do what it takes to beat it. I'm going to beat this. I want to beat. He says, that's when he differentiates. He says, do you want to beat it? Because I bet you do. The question is, will you beat it? And is that in your hands? And he said, no, I will beat it. He says, now that's a declaration. The question now is, if you state that you will beat the cancer, the question is, what are you willing to do? And the answer was, whatever it takes. When you create a declaration, it truly was, Pam. When you create a declaration from a place of I will, things start to align, things start to shift, how you approach things, how you digest things, how you process things completely change. So my reasoning for saying we want too much is that we spend the time talking about wants versus wills. I invite you to take the things that are so important to you in this next 12 months. The things that you know that viscerally, these things are the things that matter. I don't want a list necessarily of a dozen things, just 2, maybe 3 that you can make a declaration and say, I will. When we make a declaration, it could be finances, it could be relationships, it could be health, it could be whatever it is, and make the declaration from a place of I will. In fact, write it out, put it on the wall so you have that declaration that says I will. You will see that things will shift in how you approach it. Things will shift because you have to live true to the I will. And you don't necessarily have to live true to the I want. See, will is higher than I want. Okay. So that's the first thing that I wanted to chat about, because I think that this is important as we go into this year. You kind of going, well, what do I want to do this year? And in the question, what do I want to do this year, is the problem, because we're coming from a place of want. instead of asking the question, what will I do this year? What will you do this year? I'd love to hear from you. I'd love to hear your top 1 or 2 wills so we can support you, so we can celebrate you, so we can rally you, so we can cheer you on, so we can champion you. Because I know for a fact that when you make the declaration and you accomplish the I wills, just a couple every year, the impact over time, the compound effect of that over time is astronomical. So first things first, I'm going to invite you to live a life of wills and not wants. All right. So the second thing I wanted to chat about is this, completely off the topic. Hopefully that, if that makes sense to you, let me know. Completely in a different direction, but it's all about the finances and the money. And I felt compelled to do this because of something that I saw. Let's face it. You have access to people. You have access to people. Johnny, you keep me posted on this. He says, we'll break free from the yearly 40K money block. You keep me posted on this and how we can help you break free, and we'll make this thing happen. So there is no absence of people out there talking about financial advice. I'm going to lay it straight. Some of it is a load of crap. Sorry. I mean, no offense, but it's junk. And I'm going to invite you to consider the sources, consider the credibility, consider what they're saying. But they will say it with conviction. They will say it and say that they're making millions or whatever it is. They are fanning the flames of emotion. And I would be really careful. I would be really careful about who you listen to blindly, meaning that you check their sources, you check their background, you check their credibility, you check and see that they've actually are getting the results on an ongoing basis. Now, let me give you a for instance, because this is what caused me to bring this about. Is I saw a video of someone, and there's plenty of TikTok finance gurus out there and YouTube finance gurus, but I saw a video out there where this person was promoting the fact of, here's how you get yourself rich. One of the ways to do it. And that is to do this, to go buy a Lamborghini. You heard me right. So he says, go buy a Lamborghini and put it in a rental pool. And you can rent that Lamborghini and probably make $10,000 to $15,000 a month in rent. This is ludicrous in my mind, and there's a couple of things to think about. Buddha's going nuts here. Sorry about that. Let's just talk about some numbers so we understand why this is bad, and then I want to tell you what you need to do if you really want to take command of your finances, your money, and your financial future. There may be a place to buy the Lamborghini. It's not where you start. So a typical Lamborghini, if you buy it new, can be as much as $500,000. Okay, so we're not buying it new, and he said that you don't buy it new because the Lamborghini drops 30 to 40% in the first 3 years. If you drive it a lot, it's going to be 50% or more. So it loses half its value. So he says, buy it for $200,000, $250,000. That means that you're going to have to put down on it somewhere between $30,000 and $50,000. So he's saying you put $30,000 to $50,000 down, you get this Lamborghini, you put it in the rental pool, you can get about $15,000 in rent a month if it's rented on an ongoing basis. You have to split that rent with the people that are renting it, so you're going to get $7,500 of it, and you take it from there. Now, let's just talk about some numbers. This is ludicrous to consider. First off, if you buy a vehicle, in most states, there is sales tax involved. So even if I put down $40,000 or $50,000 to get into a Lambo, to rent it, and it's 250,000, I'm going to pay $18,000 in sales tax. I got to pay that up front. It's gone. Okay. Second, what's the annual maintenance on a Lambo? Well, I started looking up. It can be anywhere between $800 and $1,200 a month. Now, mind you, if you're renting it to people for short-term rentals, what are they going to do with the Lambo? Are they going to coddle it and take care of it? No. They're going to beat the crap out of it and drive it hard. And you're going to put more miles on it. The average miles on a Lambo is supposed to be about 2,500 miles. But if you're renting it, it's going to go more than that. It's going to get road wear. So the maintenance costs on it could be $1,000 or $1,200. Mind you, remember, $15,000 split in half, $7,500. If the maintenance costs are $1,200, guess what? You're now all of a sudden down to $6,000 or $6,200. What about insurance? Insurance on a car like that can run as much as $18,000, $1,500 a month. Okay. What about gas? It gets about 11 miles to the gallon. So you're going to eat up gas. And if you're in California at $5 a gallon, that's a lot. And then what about the payments? Because if you only finance $50,000 of $250,000, you've got a $200,000 loan you got to pay for. Now all of a sudden you've got payments. So by the time you're done, the $7,500 you might have gotten net, you might end up with $1,000. And what did you do? You buried your $50,000 that you had for investing into a depreciating asset that is what I call rolling stock, that doesn't have necessarily ongoing value. Now, he tried to say that it appreciates and it does all kinds of things, but I don't buy it. I literally, I don't buy it. But from just a general investing perspective, I think this is one of the craziest ideas. It's something you can do, but not until you have a foundation of investing, not until you have some things in place, because there's no diversification. Let's not even take into consideration the fact that someone's driving a high performance vehicle and you're the owner of the vehicle, and God forbid they get into an accident. What kind of liability you take on? Okay. None of that is talked about. It's just this grandiose thing about I'm making all kinds of money without really digging into the details, and follow me to show you how this is done. And I think that is going to get a lot of people in trouble. And I'm a little heated about it, if you can't tell. So what should you be doing? Whether it's a Lambo, whether it's a speculative stock, a startup, an angel investing, even crypto. We can talk about crypto another time. It's not something that I would start with. Here's what you need to start with. First things first. Always get your arms around your cash in, your cash out. Do you know where your income is coming from? Do you know where your income is going to? Do you know your expenses based on needs and wants? If you don't, we have to figure that first. We have to be on solid footing first. And this isn't about, and hear me clearly on this, this isn't about deprivation. This isn't about depriving you and saying, no, cut everything out of your life. No, I actually want you to expand your life. I want you to live fully. I want you to live big. I want you to live it all. I don't want you to shrink your life, but I want you to do it responsibly. I want you to be able to live the life today while you're building the life of your dreams tomorrow. And it's possible. But in order to do that, you have to get your arms around, where is your income coming from? Where is your income going to? What are your expenses? What are the things that I can manage? Now you can sit back and say, instead of deprivation, it's about choice and consciousness. That I'm making intentional choices and conscious choices about where I put my money. Because what we know is wealth creation isn't about the money as much as it is about the behaviors and the habits you have. So when we make those behaviors and habits intentional and conscious from a financial standpoint, we make different choices, which gets us different results. And so that first step is to get real on where your money is and where your money is going. Understanding that everything is a choice. Then we need to build. Step number 2 is to build an unshakable foundation. We're going to go through some uncertainty in the markets as we go. Now, we had a good day today. Who knows what next week will bring? All right. And so we need to have an unshakable foundation. What does that mean? An unshakable foundation means, first, you have some liquidity. If things hit the skids for any reason, if there's a decline in the economy that is prolonged, if there's a job loss or anything, Amazon just announced 18,000 people left. They expected 10,000, and now it's almost doubled to 18,000. We need the liquidity to sustain ourselves. Some people call it an emergency fund. I call it peace of mind. I need you to have the peace of mind fund in place so you can be at peace, that you can navigate when things or if things go wrong. So that's number 1, to build that unshakable foundation. We need liquidity. Number 2 is we need to manage our debt, especially destructive debt. We are in a time where interest rates are no longer close to zero. They've gone up and they will continue to go up. They probably won't go up as fast as they did in the past, but credit card rates are up in the 20s now. And if we're not careful and we're carrying balances on debt, whether it's credit cards or other debt, if it is variable rate debt, then your cost of living goes up when your lifestyle didn't increase. You're paying off past debt at a higher rate. So we need to have a debt payment plan in place to get ourselves out of that destructive debt, so we are not beholden to the adjustable rates that are going to burn us. So that's the second piece. The third piece is this. You have to build a money machine outside of your main income stream. If you have a job, if you're a wage earner, or if you are a entrepreneur, either way, what we need to do is build a portfolio of assets that allows you to live and survive and pay your bills without having to work. Now, that's going to take some time. I totally get it. But that's the objective. And when I shut everything down because of the cancer, it was the very fact that we had that money machine that allowed me to navigate it, allowed us to navigate it without having to sell stuff, without having to get rid of stuff, without having to change the lifestyle. I mean, I didn't sell anything to be able to survive, but because we had the liquidity and we had the money machine outside of it. When we start to do that, that isn't about going out and buying a Lambo and freaking renting it. That's not going to do it. It's about having a holistic plan in place that is something that's going to fund a lifestyle that you want. That you want. So it will start with you defining the life that you want. I don't need you to try and live my life. Lord knows you don't want to follow my footsteps. But I also don't want you following in your neighbor's footsteps or your parents' footsteps or the media's footsteps. I want you to follow in the footsteps of your own choosing. So to define your life and then create that life, that money machine to create that life. Well, what that means is we have to be smart about the investing. We have to be smart about building that portfolio, that money machine. And that is all about understanding risk and not taking on too much risk. When I invest $50,000 into a Lambo like this guy suggests, you're taking on a ton of risk. And there is no diversification because you're only buying one Lambo. The thing gets crashed. Yes, you have actually insurance, but you have all the other aspects of of what happens if someone decides they're going to sue you because you're the owner and the insurance doesn't cover all kinds of stuff that go on with it. But that's the only investment you have. This is why it's so important to understand your ability to take on risk, which is called risk capacity, and your ability to sustain risk, which is risk tolerance. Risk tolerance is actually the emotional part of it. And really start to look from that perspective. Then you start to allow yourself to build a pool of assets that has asset allocation. In other words, you're not going to create it just with one asset because it's too risky. I've had some people say, I'm just going because Bitcoin is so far down, I'm going all in on Bitcoin. Good luck. It could go back to $60,000. It could go back to 3. That's the thing that we need to understand. I want you to do this smart. I want you to do it in a sustainable way. Is it possible that it's a little slower? Yes, but it's a lot more permanent too. I've made the mistakes. I screwed things up. A lot of the things that I talk about, a lot of the things that I teach on are because I messed it up, and I don't want you stepping in the same potholes. If I lost, and I have lost well over $1 million and more, over $1 million just in the Ponzi scheme that I got caught up in, okay? That's an expensive education. And the only way that I can make that education make sense is if I make sure that you don't do the same thing. So I got to share it. So asset allocation and diversification. And then these are the 2 things you need to do. You got to get started. Simple as that. Get started. $5, $10, $20, whatever it is. And then keep going. It's how we all did it. 80%, over 80% of millionaires are first generation. First generation, that means they made it. They didn't get it gifted to them. They didn't inherit it. They didn't win it. They created it. Over 80%. And they did it one step at a time. So when you hear these commentators talking about how they just made a killing and it's really quick and it's easy and it sounds like too good to be true, it is. That's how I got in the Ponzi scheme. If it sounds like, oh my God, get rich quick, yeah, you might, but you might get poor quicker. So I think that it's important to base your financial wealth and your well-being and your future destiny on principles that are time-tested, principles that have worked, principles that have been through inflation, been through recessions, been through volatility, been through market corrections, been through a real estate situation. But to base it on principles, because principles are timeless, versus some meme that someone is coming to you with and saying, oh, this is the panacea, this is the way to make it. And in fact, their bent, their bias is to sell you into a program. They're not trying to make you money. They're trying to take your money into a program that's going to tell you they can do it. And you're taking on a level of risk that you shouldn't be taking on. All right. It's just, it concerns me because they can seem so believable and high production quality on the videos and it looks really convincing and promising. But more often than not, it is taking on a substantial amount of risk that you shouldn't be taking on. So those are the 2 things I want to talk about. I see some comments coming in. Let me know if you've got questions. I just couldn't go into the weekend without saying something about it. Beware of the people you watch or listen to out there and look at their credibility. Look at what their background is. Are they financial professionals that know what they're talking about, or are they just someone that is trying to sell a product or a program or something like that? I got nothing to sell you. I don't. I'm here to help. I don't sell investments. I don't sell insurance. I don't sell real estate. I'm I'm just here to try and mentor you. That's why I do these things. Okay. That's why I answer questions. That's why if you have questions, I want you to type them in. If you have questions and we're not live, you go to askmelnow.com and you send me your questions. I answer the questions. It's to give you a place where you can get some real world advice from someone that has done it, not just for himself, but has done it for his clients over and over again and across the globe. Okay. So let me see what we've got. I've got some questions coming in, and let's see if we can get some things answered. Some of you, if you're open to it and you have questions, I'll bring you on live and we can have a conversation. Let's just see. Maria's in the house. How are you? And she says her best friend, Megan, is here too. So cool. Megan, we're committed to financial freedom. This is yeah, absolutely. Mel is gold. I appreciate you, Maria. Thanks so much. Megan, welcome here. Says, I just working on my battle board. Yes. Just talking to my brother about financial freedom. So here's a question, which is really an interesting question. What does financial freedom mean to you? Not the number, not I don't have to work, but to attach it to your life in the sense that when I look at financial freedom for me meant a lot of things. It meant that I would have choice. It meant that I had the ability to take care of my dad and my mom. It meant that I could take care of my nephew and make sure he could get into the school he wanted to get into if he didn't get the scholarship. It meant that I could get behind charities that meant something to me. It meant that I can create experiences for the people I love and my wife and I. It meant that I have a choice to be here with you today, not sitting back saying, how do I make money at it? It meant that I could make every moment matter because I had choice in every moment. And I think that's the thing that I look at is that when we tie the financial freedom less to a number and more to life, which is really what it's about, now we have something to pull us through. And it forces us to define financial freedom based on the vision for our life and not some number that someone tells us it should be, whether it's the magic million or 10 million or 100 million, whatever it is. Question is, look, you could have 100 million bucks and still not have the life you want. Is that really living? I don't think so. So when we talk about financial freedom, let's define it, not just in a number, but in how we experience it, how it shows up. Okay. I'm done. Something about, okay. So how do you mitigate risk? How do you calculate ROI and risk management? This is a good question, Megan. This is it's different for everyone. It's different in the sense that your circumstances will dictate it. For instance, I am 61, although my wife says I act 12. So I'm 61. I'll be 62 this year. We have a certain level of assets. Our capacity to take on risk is higher. Our tolerance to take on risk is lower. I'm not looking to grow and take on a ton of risk because I don't need to try and be aggressive. But I also build my portfolio in a way that if one of the things go bad, I won't be happy. I'll probably mope around for a weekend, but it isn't going to destroy us financially. And so it depends on your situation. If you're younger, like my son, 32, his wife 30, they've got one little girl. Another one on the way in 2 weeks. I'm going to be a granddad number two, another granddaughter. So they're going to have two young kids. They have three homes and a multi-million-dollar net worth, but their ability to tolerate risk because they have a longer runway goes up, but their capacity to take it on is still lower. So we have to look at it through a specific set of circumstances and say, what do I need? And when you create a financial plan that is built based on a vision, you start to look at the sensitivity of the plan. You start to look at it and say, I need to make X dollars. I need to have this much in the money machine. When we build those assets, you will start to adjust that. We look at our numbers I look at them more often, but every year I'll look at our risk tolerance and our risk capacity, are the things we want to change and want to shift. When there's life changes, we look at it. When my second granddaughter is going to be born, we'll relook at how we're going to allocate assets and things like that. So there isn't just a set calculation, but there is, when it comes to risk tolerance, and is that there are different tests that you can go through. We have an assessment, a risk tolerance assessment that we give our clients that allow them to start to understand where they are on the spectrum so they can evaluate and start creating an investment thesis and an investment philosophy that fits where they are. If they're up in years, and they don't have a lot of working years left and they're choosing not to work, then you don't want to risk the capital because you don't have the ability to recover. If they're young in years, then you have the ability to recover. If you have a lot of earnings capacity, you have the ability to recover. All of that goes into it to help decide. But the first place I would look at is one, to make sure you have a good vision of what you want your life to look like. Two is to do a risk tolerance assessment to allow you to understand what your tolerance is. Now, the interesting thing is, if you're married and you have two differing attitudes towards risk, this is something that you got to navigate between you and your partner. Okay. And then three, you get a plan in place that is built around that risk model. So you take on investments and an investment structure that doesn't put you into any risk. If you know what your risk tolerance and risk capacity is, you're not buying a Lambo to rent it. Okay. All right. So working mom divorce, she says, how do you protect yourself for a business starting up for alternate income? Are you still on, and would you be willing to come on live with me so I can get more clarity? Is the intention to direct to coaching? I missed the 2 points. Oh, I'm not sure, Megan, what you're referring to. Let me know if you're on. I'll bring you on live. Also, Maria says, thanks for answering my question during the last live about the LLC and S Corporation. I filed my LLC already. Oh, perfect. All right. I'm stuck on how you described the two separate entities to create the license agreement at the coaching summit. So part of that is also going to be dependent upon the state you're in, Maria. What I discussed at the coaching summit is state specific. So what the key is this: your intellectual property needs to be separate and apart from your delivery entity. We don't want the two to meet. The delivery entity is where the liability is. The intellectual property is where the asset is. And so you want to talk to an attorney in your state based on the state laws to structure it so we can keep them separate and create a licensing agreement between the two. IULs? I don't do a lot. So there are very few times that I will, so this is, Megan's asking about index universal life insurance. So I am not a big lover of using life insurance as an investment vehicle. We will do it in certain situations. It creates complexity that people are typically not ready for. There is a high fee structure and expense structure, so I don't like it. But you will see a lot of that being proposed when anytime the markets decline or you have volatility, they come in and say, we could guarantee your returns. You don't have to worry about it ever again. And they come up with these different structures. They indexed universal life, whole life policies, all these kinds of things. I try to separate them unless they can make a compelling argument as to why this is not good for me. This is the best thing for me at this time. And they're really transparent on how the fees are done, the expenses, and when I can have access to that money. Because especially in a whole life policy, if it's not designed correctly, guess what? It's going to take you 5, 6, 7 years before you can get any kind of cash value in it to be able to do the things that they say they want you to do with it. So I'd be really careful. It just depends on the terms and the riders that are on the policy. But I typically will separate my insurance needs from my investing desires. Okay. In most cases, doesn't mean it's always that way. Okay. Working mom, I don't think it's available. I'm not sure what we're talking about there. I've done low risk investing with my Roth. Okay. Although at 28, I have the ability to take more risk and would like to, but my mentors have advised against it due to the economy and the market. Megan, are you still on? I'd love to get bring you on live and maybe have a conversation around that. I'd love to do that. So happy to see you today. Yeah, I was on with Brendan also. Either one, working mom, divorce, or Megan, ask to come on live with me, and I'll bring you on live, and we'll chat. Okay, I'm gonna see if I can do it from here. Go live. See if she wants to come live. If you want to come live, unable to join. Okay. Then let me try the other one. She's not on, so I can't do it. Okay, so let me answer the questions. They can watch it on the recording. So if you're Megan, if you're 28 years old, you've got a long road ahead of you. Okay. Depending on how conservatively or low risk you are investing, it doesn't make sense if you're ultra conservative. And I don't know what your portfolio looks like, but when you look at the market, it goes up 8 out of 10 years. We just happen to be in those couple years that it may not be going up. Totally fine. But the average market has grown between 8 and 12% in the long term. If you look at any 10-year period, it doesn't go down. If you're too conservative, your Roth, you can't touch it. Bottom line is, you're 28 years old. Right now, you can't touch your Roth for another 31 years till you're 59 and a half. You got 30 years on this money. Do you think in those 30 years you're going to have some down years? Yes. Do you think you're going to have some up years? Well, if I look at it and say 8 out of 10 years, it goes up and I have 30 years, that means I'm going to have 24 years of up and maybe 6 years of down. So at 28 years old, I